All right, let's just dive right into this. Welcome to our practical explainer playbook for IAS 2 inventories. If you deal with financial reporting, you know that how a company accounts for its inventory can drastically alter its reported profitability. Today, we're stripping away the academic fluff and getting straight to the core mechanics of International Accounting Standard 2. Here is our minimum coverage checklist for today: scope, objective, and recognition, initial measurement of inventories, subsequent measurement and expense, disclosures and standard interactions, exceptions, judgments, and estimates, and finally, common application errors.
Section 1. Scope, Objective, and Recognition.
So the crucial point here is that this standard is fundamentally about timing. When exactly do costs sit safely on your balance sheet as an asset, and when do they drop down to hit your income statement as an expense? IAS 2 dictates exactly how much cost you can capture and carry forward until you actually sell the product and recognize the revenue. Okay, so how do we know if an asset even belongs here? We use a pretty strict algorithmic logic. You recognize an asset as inventory when literally all of the functional criteria match your operations. If it's held for sale in the ordinary course of business, then recognize it as inventory. If it's in the process of production for such a sale, then recognize as inventory. And if it's in the form of materials or supplies to be consumed in production, then recognize as inventory. It's a simple functional test.
Section 2. Initial measurement of inventories.
Now, if you take away only one thing from this entire explainer, let it be this golden rule. Inventories shall be measured at the lower of cost and net realizable value. This single sentence absolutely dictates everything that follows in the asset's life cycle. You can never overstate the value of your inventory. You are always bound by the lower of what you paid to get it or what you can actually get for it right now. Let's see how this actually builds. When calculating cost, what exactly is included? Imagine purchasing some raw steel. You'd include the purchase price and non-recoverable taxes, the import duties, and the transport and handling to get it to your factory. And once it's there, you add your direct conversion costs, like labor, and a systematic overhead allocation. By the way, if you buy that steel on deferred settlement terms, the base cash price is included, but any hidden financing interest is entirely excluded. We have to strongly contrast that with what is explicitly excluded. Say you have a massive power outage and ruin a ton of raw steel. That abnormal waste is excluded. It hits your P&L immediately. What about storage? General warehouse storage for finished goods is excluded. Only storage costs that are absolutely necessary during a multi-stage production process can be capitalized. And administrative overheads or selling costs? Completely excluded. Keep them completely off the inventory valuation. The standard gives us a literal policy choice here for ordinarily interchangeable items. You can use the first-in, first-out formula, FIFO, which assumes your oldest stock is sold first, naturally leaving your newer, more recent costs sitting on the balance sheet. Or you can use the weighted average cost formula, which averages costs over the period and kind of smooths out price fluctuations. Just remember, for custom, non-interchangeable goods, think a custom-built yacht, specific identification is mandatory. There's no choice there.
Section 3. Subsequent measurement and expense.
Let's revisit our golden rule and define net realizable value, or NRV. It is your estimated selling price in the ordinary course of business, less the estimated costs of completion, less the estimated costs necessary to make the sale. And a really crucial distinction here. NRV is an entity-specific metric. It is not some generic fair value determined by the open market. It's specifically based on what your business actually expects to realize from the sale. To make this super clear, we need to map out the exact flow. If inventory is sold, then you derecognize the asset and the impact hits the P&L as a cost of sales expense. If NRV drops below cost, then you write it down item by item, recognizing it immediately as an expense on the P&L. But what if economic conditions improve later? Then you actually reverse that previous write-down, creating a reduction of inventory expense on the P&L. Finally, if the inventory is used to build your own internal property, plant, and equipment, then you allocate it to the new asset, capitalizing it to PPE on the statement of financial position.
Section 4. Disclosures and standard interactions. The disclosure requirements here are quite detailed. If policies are chosen, then disclose the cost formulas used. If carrying amounts exist, then categorize them, splitting out raw materials versus finished goods. But here's the fascinating part. If write-downs or reversals occur, then you don't just drop a number in the footnotes. You must disclose the qualitative circumstances. You have to literally tell the full story behind those numbers. And, naturally, if inventories are pledged as security, then you must disclose the carrying amount.
Now, IAS 2 certainly doesn't operate in a vacuum. It plays with the rest of the IFRS ecosystem. It supplements IAS 16, meaning spare parts are PPE if they meet the definition, otherwise they default right back to IAS 2 inventory. It entirely defers to IFRS 15 for contract fulfillment costs, and it actually modifies standard rules under IAS 23. While we said interest is usually excluded, if your inventory takes a substantial amount of time to produce, like aging whiskey, you can actually capitalize borrowing costs directly into the inventory.
Section 5, Exceptions, Judgments, and Estimates.
We really have to emphasize these stark scope boundaries. The rules apply to almost everything except when you are dealing with financial instruments or biological assets at the point of harvest. Those are entirely carved out of IAS 2. Don't make the mistake of accidentally applying inventory costing rules to those specialized assets. Furthermore, the measurement rules apply everywhere, unless you operate in some very specific conditional industries. If you're a commodity broker-trader or an agricultural producer using established practices, you skip the lower of cost in NRV rule. Instead, you measure directly at fair value less cost to sell or at NRV and recognize any changes directly in your profit or loss. We also need to flag a massive area of estimation uncertainty. Determining NRV requires forecasting future selling prices, analyzing post-balance sheet price fluctuations, and assessing firm sales contracts. NRV isn't just a hard number you look up on a receipt. It is a forward-looking prediction that is highly vulnerable to market volatility. It requires a lot of intense professional judgment.
Section 6, Common Application Errors. Let's troubleshoot some real-world mistakes. Error 1 is improper overhead allocation. The mistake in Step 1 is aggressively capitalizing administrative overhead or general selling costs into inventory to make the current period look better. The correct treatment in Step 2 is that these must be expensed immediately to the P&L. Only true production-related overheads are ever included.
Error 2 is grouping write-downs broadly. The mistake in Step 1 is writing down inventory based on massive, broad classifications, like just assessing all finished goods together. The correct treatment in Step 2 states that write-downs to NRV must generally be calculated item by item. There are only very rare exceptions for highly related product lines. And finally, Error 3, ignoring write-down reversals. The mistake in Step 1 is writing down inventory during a bad year and leaving it permanently impaired forever. But the correct treatment in Step 2 requires you to reassess NRV every single period. If circumstances in the market improve, that write-down absolutely must be reversed, up to its original cost.
So, what does this all mean for the actual business? Well, if your inventory sits on the balance sheet too long, is your cost formula just hiding deeper operational inefficiencies? Or is it simply time for a ruthless NRV write-down? Understanding IAS 2 really empowers you to see the true economic health of a business. Use this explainer to your advantage, and we'll catch you next time.